Which of the following is not the use of financial accounting? A, has primary emphasis. It's not the use of financial accounting here. Not. Primary emphasis on providing timely information for decision making, even if it is the best estimate. That's kind of true. It's required by regulatory bodies such as the SEC. That is the use of accounting. So I'm going to write here financial accounting, because that is financial accounting. Focuses on the organization as a whole. That is financial accounting. Is concerned with preparing earnings per share ratio. That is financial accounting. We talked about that in 2103. So the answer really is A. That's not financial accounting, because financial accounting is more concerned with accuracy than it is with timeliness. Last year, a company has sales of $400,000, turnover of 3, and return on investment of 30%. Net operating income for the year was, and then if you remember, we had these formulas that dealt with these also from chapter 12. So these are more formulas that you probably want to add to that sheet. I don't know where the sheet is now, or again, I haven't looked at the sheet. So they want to know net operating income, and this is kind of tricky, right? So with sales, we have sales of 400,000, turnover of 3, and return on investment of 30%. So for turnover, remember the formula for turnover was equal to sales divided by average assets, or average operating assets. So here, my turnover is 3, sales is 400,000, and average assets, I don't know. So then average assets must be equal to, this is crazy, 400,000 divided by 3, or 133,333. Okay, now we had a return on investment of 30%. So return on investment equals, am I even doing this right? Is equal to net operating income divided by average assets, in this case. So I know my return on investment is 30%. And I know, I want to know my net operating income. And I know my average assets is 133,333. So then my NOI, 30% times 133,333 equals $40,000. It's getting kind of late. So the answer would be D. Wow, that's really hard. Which responsibility center has the ability to reinvest its profit? So we got to know what these centers are. Cost center focuses only on total cost. So obviously there's no investment that happens there. Profit center focuses on net operating income divided by sales. So there's not that either. Revenue center only focuses on sales. So the answer must be investment center, because that focuses on profit, revenues minus expenses, of course, and it also focuses on the amount of investment. The contract with an outside firm for providing temporary workers for the department store is an example of, this is chapter 5. Chapter 6. I don't know where it happened that we were covering chapter 6 on the first exam, and that we didn't do that this time. Well, because I have more coverage. We're doing more on chapter 5. Chapter 5 is also, quiz here, question 5, is also really 6, but let's talk about it anyway. This is about how to allocate costs and what would be a good allocation base, which we kind of have talked about, but it's really the focus of Chapter 6. The answer happens to be C. The number of children. That you would think that the more children in a daycare center, the more children you have, the more overhead. And anyone with a lot of children, like myself, can tell you that. Which combination of terms? That was funny, no? You guys, that was a great. Anyone with a lot of children can tell you that. That was no. All right, fine. It wasn't funny. Just ignore it. Which combination of terms describe the amount paid for direct labor used to make chocolates? Okay, so we have direct labor. It's a variable cost, right? It's a product cost. And it's also a direct cost because you know how much direct labor is used to make each chocolate. So it looks like it's going to be the answer A. Let's look at the other ones. Direct labor is not a fixed cost, so it's definitely not B. It's a variable cost. It's a period. It's not a period cost because it's a manufacturing cost. It says to make. It's not a fixed cost. I don't know what a differential cost is. We haven't talked about that. It's definitely not an indirect cost. So your answer is going to be A. Now we talk about predetermined overhead rate. Clear Colors Company uses a predetermined overhead rate based on direct labor costs to apply manufacturing overhead to jobs. Beginning of the year, the company estimates total manufacturing overhead cost was $350, direct labor cost is $200,000. So it's going to be based on direct labor cost. I want you to notice here that it's cost and not hours. Okay? So to calculate this, you would take the estimated total manufacturing overhead of $350,000 and you would divide it by the direct labor cost of $200,000 in order to get the overhead application rate. What's 350 divided by 200?
It's 1.75.
So that would be your overhead allocation rate. So it tells you here the actual overhead cost. It tells you the actual direct labor hours was 280. So 175 times the actual direct labor hours, because we're doing direct labor hours here. So what's 1.75 times $208,000? No. What's 1.75? No. What's 1.75 times $208,000?
The answer is 364,000 US dollars.
So the actual, the amount applied, we would have applied 364,000. The actual was 362,000. Is this over applied or under applied, everybody? It's over applied by $2,000. D. Break-even units sold will decrease if they, oh, this is hard, man. Oh. Break-even in units sold. What's the formula for that? Total fixed cost divided by what? The contribution margin per unit. So what would cause this to decrease? So if unit sales volume I don't get it. Unit sales volume, that's the number of, that would be the answer, right? That just doesn't make any sense. If total fixed expenses increases, right, then the break-even in units would also increase. So that's definitely not the answer. Watch this. This is pretty cool. It's a little eraser. If increased tax would increase total fixed cost, could be variable, so that doesn't work. If you increase selling price, then contribution margin per unit would increase, and therefore break even would decrease. And that just makes sense, right? Because if your selling price is higher, you're going to make more on every unit you sell, so you can sell fewer units. Departmental overhead rates are generally preferred to plant-wide overhead rates when, that's chapter 6. The firm estimating the expected manufacturing overhead for the following year to be $3 million when it actually was $2.4 million. This will lead to, so again, we applied $3 million and actual was $2,400,000. So this was again over applied. So if we, this is a profound question here. This really takes a lot of thought. If we over apply overhead, remember what manufacturing overhead applied does. It's like a tax on the product. We assume then the product was more expensive than it really was. So if you assume the product was more expensive than it really was, then what's going to happen? How about A? Yeah, you're going to charge a higher price. How about B? Obviously, you have a higher predetermined overhead rate. That's what POHR stands for, I guess. Predetermined overhead rate. Potential loss of customers? Yeah, because your price is too high. So the answer here is D, all of the above. Now we have a few more minutes. Here we go. I think I wrote this. It's from last year, but I think I wrote it. It looks very familiar. So there, oh yeah, I didn't write it. I like doctored it up. Someone else wrote it, and then I like did my magic. Holtzman's magic. So anyway, part 2. When I get back to my office now, it's going to be a nice cold cup of coffee just sitting there. A cup of coffee I should have drank 2 hours ago. So we got here total. Let me leave another column here. Total per unit. You can tell I wrote it because I like this format. Sales, variable expenses, contribution margin, fixed expenses, and net operating income. It'd be pretty funny. I'm not saying that I did this. Honestly, I don't remember. Writing an exam with 4 different people is not an easy thing to do, so I can't tell you if this is on the exam or not, and I won't. But it would be pretty funny if, and you can see, I think this is on both of the old tests, that we give you the format of the contribution margin income statement here, and then later on, we asked you to make a contribution margin income statement, and students were like, well, I don't remember that. Well, if you go from part 3 and you look back at part 2, there it is. So you can memorize. This is not hard to memorize, these 2 steps, right? We're talking about 2 steps. Sales minus variable expense equal contribution margin, that's step 1. Minus fixed expense equal net operating income, that's step 2. It's not a lot to remember, but if you don't remember it, then it may be laid out for you in a problem like this, and then you can just piggyback on that. Just a test-taking strategy here. Because oftentimes your professors are not. So this is weird, right? It doesn't tell you fixed expenses, and they want you to like fill this all out. So let's fill this out. And they want you to fill the whole thing out. So they want, I guess, per unit and numbers and stuff like this. So we'll do that too, I guess. How many did they sell? They sold 15,000 units, huh? So this would be sales divided by 15,000, or 50, and then variable expenses divided by 15,000. This is like horrible Excel. This is not how to do things in Excel, really. What's fixed expenses? That would be 150 minus 60, right? 90,000. You look at it, well, 150 minus 90 is 60. That's good. Now, fixed expenses per unit, we always kind of shudder to do that because we know that fixed expenses, no matter how many units you sell, is going to stay the same. Excuse me. And net operating income is going to be $4 a unit, assuming that you make 15,000 units. Now, how about as a percentage of sales? Again, I'm going to do 750 divided by itself is just 100%. 600 divided by 750 is 80%. 150 divided by 750 is 20%. 90 divided by 750 is 12%. And 60,000 divided by 750 is 8%. And let's just write this in percentage terms like that. Okay, next. So I completed my table. Now, break-even point in units. I'm going to go as far as I can in the amount of time we got. I got exactly enough time, by the way. If we end at 10:45, I got an 11 o'clock meeting. So we'll go as far as we can to finish 10:45, and then everything else I'll add on over the weekend. Break-even point in units. What's the formula for that again? Fixed costs divided by what? Contribution margin per unit. So in this case, my fixed cost is 90,000. The contribution margin per unit is 10. And therefore, break-even point in units is going to be 9,000. 9,000 units. Very important. Units. The break-even point in sales units, in sales revenue, what was the formula for that? That would be total fixed cost again, divided by what? Contribution margin ratio. Half of this is just knowing the formula, and the other half is knowing how to put these little things together. So fixed costs, again, 90,000. Contribution margin ratio is 20%, because contribution margin divided by sales is 20%. So that would come out to 90,000 divided by 20%, or $450,000. Degree of operating leverage at last year's sales level. We did this. So do you remember the formula for degree of operating leverage? Oh, it's so funny, it's not even here. So the degree of operating leverage, does anybody remember? Equals what? Contribution margin divided by net operating income. So here my contribution margin is 150. My net operating income is 60. And that would turn out to be 2.5. Do you remember what that means? It tells you how an increase in sales at that point is going to impact your profits. So if you produce another 100 units, it's going to increase your profit by $2,500. And margin of safety, remember the formula for that? Those were two other formulas that we did, I think, in chapter 2 or 3. I think chapter 3. It's actually called margin of safety in net operating income, I think is the formal definition. Anybody? So it's current sales minus break-even sales. Or you can do current sales in units minus break-even sales in units. So I'm going to do both, dollars and units. So my current sales, because I have all the data I need, current sales in dollars is 750, and current sales in units was 15,000, and break-even sales in dollars was 450,000, and break-even sales in units was 90,000. So margin of safety in dollars would be 750 minus 450, and in units it's going to be 6,000 units. Part 3. Pirate Products computes its predetermined overhead rate annually based on direct labor hours and made the following estimates at the beginning of the year. Estimated direct labor costs were $200,000. Average rate for direct labor was $20 per hour. Fixed manufacturing overhead was $280,000. And variable manufacturing overhead was $2 per hour. And actual manufacturing overhead for the year was $356,700, and actual direct labor hours were 11,000. Question 1, the direct hours the customer estimated will work kind of requires a little bit of creativity here. You have to look at the information that you have. And you can see here that estimated direct labor cost is $200,000, and the average rate for direct labor is $20 an hour. So from those two things, we can sort of back out the information. So again, estimated DL costs is $200,000, and the average rate for direct labor. So if we thought total cost was going to be $200,000 and the average rate was $20 an hour, then the estimated number of hours must have been 200,000 divided by 20, or 10,000 hours. And that would be the answer to number 1. To calculate the total, and that's in fact what you have to do with a lot of these problems, is you just have to be a little creative and look at the information you have and kind of figure it out. There isn't a magic, we could give you every possible formula for every possible thing, but sometimes you just have to think. So if total cost is $200,000 and it's $20 for direct labor is $200,000, and on average people make $20 an hour, then you must be assuming that people are going to be working 10,000 hours. Calculate the total estimated overhead. So the way this works, we'd have the fixed overhead plus the variable overhead. So fixed overhead estimated fixed overhead is given to us as $280,000. The variable overhead per hour is $2. The estimated number of hours to work is, we figured out, 10,000 hours. So the total variable overhead should be 2 times 10,000, or 20,000. And that would give us, so total estimated overhead would be 280,000 plus 20,000, or $300,000. Compute the company's predetermined overhead rate for the year. And what this problem is kind of doing is just taking you through this step by step. They could just ask you for overhead number 4, overhead over or under applied, and then you would have to go through these steps anyway. So predetermined overhead rate for the year. Remember that predetermined overhead rate is equal to total estimated manufacturing overhead divided by the number of units of your allocation base. And again, this is one of the things that you might want to put on your formula sheet if you're putting in a formula sheet. So total estimated manufacturing overhead is 300,000. And we're going to be allocating overhead based on the number of direct labor hours. And we estimated that to be 10,000. So therefore, 300,000 divided by 10,000 is equal to $30 per hour. Kind of rearrange this a little bit. So it's a little easier to follow my work. Calculate applied overhead and indicate whether it's over or under applied. And we're going to go a step further, figure out how much was over or under applied and what you would do with that. So applied overhead would be the actual number of hours. Now I'm going to point out a point of confusion here. This might be a question you have. It's a real limitation when you do a video like this, because if you have a question, you're just stuck. You're probably like, but what about, I have 2 rates here. Average rate for direct labor is $20 an hour, and variable overhead is $2 an hour. And now I've introduced a new one. Predetermined manufacturing overhead rate is $30 an hour. So let me go into what the difference between these things is. Okay, first off, I've determined the variable rate for manufacturing overhead is $2 an hour. In other words, every hour that's worked is associated with $2 worth of overhead. There's also some fixed overhead, which is $280,000. That's a lot more money. And that's how we got a total estimated overhead for the year of $300,000. So it should be noted that this is just the actual behavior of the cost. In other words, I've estimated that for every hour, there is approximately, manufacturing overhead is probably going to go up by $2. Now, I've also estimated that for every hour, direct labor is going to go up by $20 because I have to pay workers. So the number of direct labor hours is actually expected to drive two different costs. The actual direct labor itself, that's how much you pay your workers, and manufacturing overhead by another $2. So for every hour worked, there's a little more electricity, a little more utilities and things like that, various costs in the factory that are going to go up. So I've estimated here that total overhead is probably going to be, if employees work 10,000 hours, total overhead is going to be $300,000. That's separate from direct labor costs. That's overhead. It's going to be $300,000. And employees are going to work $10. So what I'm going to do is, to estimate the cost of my products, I'm going to say that for every direct labor hour worked, I'm going to zap those products with $30 worth of overhead. Now, that is a problem because we know that variable overhead is only $2 an hour. And suddenly I'm allocating goods for overhead at $30 an hour. What is the difference between this and this? And this is critical to understanding the difference between variable costing in Chapter 3 and absorption costing in Chapter 4. Here's the story, okay? This is how cost behaves. Every hour that an employee works, overhead is probably going to go up by $2. And most overhead is fixed. But when I'm estimating the cost of products and when I'm allocating overhead to the goods that I produce, I'm going to use this predetermined overhead rate. I know this is not really how costs behave because variable overhead is only $2 an hour. But I've also got to allocate that fixed cost. And I figured out that on average, fixed cost is going to be about $28 per hour. So every hour worked on something is going to carry with it a kind of a tax of $28 an hour. And that is for the fixed overhead, which gets allocated to the goods, because you can't make the goods without that fixed overhead. So employees worked a total of 11,000 direct labor hours. And we've already determined, we've got a predetermined manufacturing overhead rate of $30 an hour. Therefore, the total manufacturing overhead to be applied is going to be 11,000 times $30 or $33,000. I'm sorry, I said $330,000. So that would be the total applied overhead, and that's what the problem is asking you for here. Let's go a step further, though, and add in, and they want to know whether it's over or under applied. So the problem tells us here that the actual manufacturing overhead came to $356,700. So we applied to goods, $330,000 worth of overhead, but the actual overhead was higher. It was $356,700. That would mean, okay, if you subtract the applied and you take the applied and you subtract the actual, you have here manufacturing overhead over applied of $26,700, which is negative. Under applied. manufacturing overhead underapplied was $26,700, meaning that we had a total of $356,700 in overhead, but we only applied to products $330,000, meaning that we undercosted our products by $26,700. So therefore, manufacturing overhead was underapplied. And now what do you need to do? It needs to be applied. It needs to be allocated to something. This is going to increase, and the problem doesn't ask you for this, but it could. This is going to increase cost of goods sold. Because these were additional costs that you had. You had an additional $26,700 that you didn't apply to any products. And therefore, you're going to increase cost of goods sold by $26,700. This will be a direct adjustment to cost of goods sold. And again, one thing which I noted in when I was going over this, that this if it's very large, it will be allocated between ending inventory and cost of goods sold. Your book never goes into this. If you take cost accounting later on, you'll see how this is done. So what additional information would you need to calculate total product cost at year end? So to calculate total product cost is going to consist of several different items. It's going to consist of direct materials, direct labor, and manufacturing overhead. And we would say per unit, we don't know how many units were produced. We don't know how many what the direct materials cost here is. We do know that direct labor per hour is $20 an hour, but we don't know what it was per unit, right? It could take 5 hours to make something, so this doesn't quite tell you. The same thing with manufacturing overhead is we know, so we're going to need to know how many direct labor hours needed per unit is one of the things that we're going to need to know. And we can use that to figure out direct labor per unit and manufacturing overhead per unit. So we would need to calculate direct materials per unit, which we don't have here. To calculate direct labor hour per unit, we would need to know, we know how much each direct labor hour costs, but we would need to know how many direct labor hours go into each unit. And same thing for manufacturing overhead. We know that manufacturing overhead is $30 per hour, but we don't know how many hours you need to make a unit. So that's going to be an additional thing that you would need to solve this problem. So part 4, selected sales and operating data for 2 divisions of a structural engineering firm are given as follows. And we have various sales, average assets, and they want you to calculate these formulas. Again, these formulas you might want to put onto a formula sheet and make sure that you remember them. So here we go. Compute the return on investment for each division by using the formula stated in terms of margin and turnover. Calculate margin and turnover before you show ROI. So first thing to do here is to calculate margin. And if you remember, margin is equal to net operating income divided by sales. So net operating income in this case is $1,900, sales is $20,000, and then you would get margin equal to $1,900 divided by 20,000, or 9.5%. So again, EBA/B. And just to make this pretty, I'll give you percentages. Now turnover, if you remember, is sales divided by average operating assets. So my sales is 20,000. My average operating assets is 8,000. And if you divide one by the other, 20,000 divided by 8, you get 2.5. And then the last thing they want now is return on investment. So if you remember, return on investment equals margin times turnover. So I have my margin and I have my turnover. Margin is 9.5%. Turnover is 2.5. So therefore my return on investment would be 9.5 times 2.5, or 23.75. And if you want to check your work here, it should be that return on investment is equal to net operating income divided by average operating assets. So let's just try that to see what happens, just for laugh. Net operating income divided by average operating assets is equal to, again, the same thing, just with a rounding difference. So you could check your work that way. Compute residual income for each division. So residual income is equal to net operating income. And again, you want to get all these formulas down. It's going to be equal to net operating income minus the minimum required rate of return times the average operating assets. So in this case, net operating income is equal to 1900, and the minimum required rate of return is 15%, and the average operating assets is equal to 8,000. So if I do these, E, F, G, it's E minus F times G. I get E minus F times G, 700. And for division B, I get 200. Like so. So this is a matter of knowing the formulas and then being able to plug them in. Assume that each division is presented with an investment opportunity that would yield a 13% rate of return. A, if performance is being measured by ROI, which division or divisions would probably accept the opportunity? So in this case, you can see that the return on investment right now for division A is 23.8%. So if division A accepted, then this project, then a 13% project, well, let me put it this way. Accepted a 13% project, then its overall ROI would get dragged down by this project. It would not want to take it. Because right now, Division A has a return on investment of 23.8%. If it takes a 13% project, then there's not much point in it, then its ROI would go down because the 13% would drag down the 23.8%. And likewise, if Division B accepted a 13% project, then its overall ROI would also get dragged down from 14.7% by this project. It would not want to take it. Now, B, if performance is measured by residual income, and you have to address both of these here, then you would compare 13%. Compare 13% to the required rate of return. So this project for Division A, let me write it again, Division A, so we remember what we're talking about here. Division A and Division B. This project has a rate of return of 13%. And minimum required rate of return is, if you remember, 15% for Division A and 12% for Division B. So Division A would reject this because the project is less than the minimum required rate of return. So their rule is don't accept anything under 15%. This is only 13%, so they're going to reject. Division B is going to accept because they'll take anything over 12%. This is 13%, and therefore they should accept. And I should just note that if you're measuring by ROI versus residual income, you will have different decisions because under return on investment, you're rejecting everything. Under residual income, Division B will accept this project. So the way you measure it will impact your decision.